Imagine this. You sell a rental property in 2024. You've had it for 20 years. You clear a $180,000 gain. It's a great day, the kind you worked decades for. You and your spouse celebrate over dinner. You feel set. Then, 14 months later, a letter arrives from Social Security. Your Medicare bill is going up, not by a little, by hundreds of dollars a month for both of you for the whole year. Because of that one good afternoon in 2024 that you thought was behind you. That's not a mistake. That's not random. That has a name. It's called the IRMAA tax bomb, and most retirees walk right into it without ever knowing it exists. If you're on Medicare right now, or you will be in the next few years, stay right here, because what I'm about to share could save you thousands of dollars. And if this is the kind of thing you want more of, hit that subscribe button right now. We cover exactly this every single week. At the end of this video, you're going to know exactly what IRMAA is, why it's built in a way that almost guarantees it'll catch you off guard, and the 5 specific income moves that trigger it most often. And I'm going to walk you through 4 concrete tools, including a little-known government appeal form that could reduce or completely eliminate the surcharge if your income has dropped. We're also going to talk about something called the widow's penalty. It's one of the most financially devastating traps in all of Medicare, and almost nobody warns surviving spouses about it. Let's get into it. Everything you're going to hear today comes directly from official sources. The 2026 bracket numbers come straight from the Centers for Medicare and Medicaid Services, what most people call CMS. The appeal form I'll tell you about is a real government form, available right now at ssa.gov. And the projection that nearly double the number of retirees will be paying the surcharge by 2031. That comes from the Medicare Board of Trustees. This isn't opinion, this is the rule book, and today we're going to read it together. Let me start at the beginning, because most people hear this word IRMAA and they freeze up. So let's slow down and make this simple. IRMAA stands for Income Related Monthly Adjustment Amount. That's a mouthful. Forget the name. Here's what it actually means in plain English. When you turn 65 and go on Medicare, you pay a standard monthly premium for Part B. That's the part that covers your doctor visits and outpatient care. In 2026, that standard premium is $202.90 per month. But here's the thing. The welcome packet doesn't explain clearly. If your income was above a certain level, Medicare adds a surcharge on top of that premium. It also adds a surcharge to your Part D prescription drug coverage, and those surcharges aren't small. Think of it like this. Imagine Medicare is a highway. Most drivers pay the standard toll at the booth, but if you drove a big rig through in a certain year, they charge you more. The problem is, you're paying the big rig toll 2 years after you drove through. And by the time the bill arrives, you've already forgotten what you did. That's the trap. Now we're going to spend the next few minutes making sure you understand exactly how it works. At the first income tier, your Part B premium jumps from $202.90 to $284.10 per month. At the top tier, it hits $689.90 per month. That's more than triple the standard premium from one letter, one number on a tax return from 2 years ago. According to the Medicare Trustees Report, right now about 5.1 million Medicare beneficiaries are paying IRMAA surcharges on their Part B coverage alone. That's roughly 7 to 8% of everyone on Medicare, and that number is projected to nearly double to 13.8 million people by 2031. Most of them didn't see it coming. Most of them still don't fully understand why they're paying it. And that's exactly why we're here today. Here's where I need you to really pay attention, because this is the part that makes IRMAA so different from anything else in your financial life. Your 2026 Medicare bill is based on your income from 2024, not what you earned this year, not what you earned last year, 2 years ago. The Social Security Administration looks at your 2024 tax return to decide what you owe for Medicare in 2026. That's it. That's the whole mechanism. And it creates what I think of as a time-delayed bill. A financial decision you made 2 years ago is showing up on your doorstep today, and there's nothing you can do about it retroactively. Let me give you a real example of how this plays out. Meet Gerald. He's 64 years old. He listens to a financial podcast, hears about Roth conversions, and decides to convert $150,000 from his traditional IRA to a Roth IRA in 2024. Smart move in theory. He's been told it'll reduce his future RMDs and save him money on taxes down the road. His regular income that year was $35,000. But the $150,000 conversion got added to his income on his 2024 tax return. So his total income for that year, what Medicare calls his MAGI, his modified adjusted gross income, jumped to $185,000. 2 years later, Gerald is on Medicare. He gets a letter from Social Security. His Part B premium is going up significantly. His Part D has a surcharge too. All told, that one Roth conversion triggered approximately $4,735 in extra Medicare premiums for 2026, according to a case documented by Kiplinger and financial planner Nancy Gates. Now here's the important thing. Gerald's Roth conversion may still have been worth it in the long run. The math on lifetime tax savings can still work out in his favor. But the shock was real. The financial sting was real. And nobody told him this was coming. That's the time bomb. You make a decision today. The bill arrives 2 years later. And if you didn't plan for it, there's very little you can do once that tax return is filed. The income thresholds for 2026 are based on what you reported on your 2024 tax return. For a single filer, the IRMAA surcharge kicks in when your MAGI exceeds $109,000. For married couples filing jointly, the threshold is $218,000. Cross either of those lines by even $1, and the surcharge applies for the full year. And here's the cliff that catches so many people off guard. It's not a gradual slope, it's a cliff. $1 over the line, and your Medicare cost jumps. For a married couple, crossing into the first IRMAA tier by a single dollar costs an extra $2,297 per year, combined. And if you cross into the second tier, that's another $3,475 per year on top of that. Stay with me, because the 5 most common triggers for this are coming up right now. Let's talk about the specific income events that most often push retirees over the IRMAA cliff. Because this isn't random. There are patterns. And once you see them, you'll understand why this is such a widespread problem. The first trigger is required minimum distributions, or RMDs. Once you turn 73, the IRS requires you to take money out of your traditional 401k and IRA accounts every year, whether you need it or not. As your account balance grows, so does the RMD amount. For many retirees, those forced withdrawals are the main reason they cross the IRMAA threshold. And because the withdrawals are required, there's no easy way to simply not take the money. The second trigger is a Roth conversion, which we just saw with Gerald. In the year you convert money from a traditional IRA to a Roth, that entire converted amount shows up as income on your tax return. If you convert a large amount without thinking about what it does to your MAGI, you can easily push yourself into a higher IRMAA tier, or even several tiers higher, for the following 2 years. The third trigger is selling a home or investment property. If you sell a house you've owned for decades, or a rental property, the capital gains on that sale can spike your MAGI significantly in a single year. You feel the joy of that financial windfall. But Medicare sees the income, and 2 years later, it sends you a bill. The fourth trigger is a large one-time IRA or 401k withdrawal. Maybe you need a new roof. Maybe you want to help a child with a down payment. Maybe you're planning a trip of a lifetime. You pull out $80,000 from your IRA in a single year. That $80,000 gets added to your Magi, and depending on what your other income looks like, that single withdrawal might push you over the cliff. The fifth trigger is something most people don't think about at all. It's the slow creep of pension COLAs and Social Security increases. Every year, many pensions give you a small cost of living raise. Social Security benefits go up too. Those increases are nice, but over time, they quietly push your total income higher. And one year you cross the line without doing anything different at all. Now here's the one that surprises even financially savvy retirees. And I want you to hear this clearly. Municipal bond interest counts toward your IRMAA income. A lot of retirees hold municipal bonds specifically because the interest is federal tax-free. And it is federal tax-free. But for IRMAA purposes, that interest gets added back into your Magi. Medicare sees it. So if you've been telling yourself, my muni bond income is invisible to the government, I want you to know it is not invisible to Medicare. It counts. That's a critical distinction that too many people miss until they get the letter. All right. I've spent the last several minutes telling you how this thing works and what can go wrong. Now let's talk about what you can actually do about it. Because here's the thing. IRMAA is a rule. And like most rules, once you understand it, you can work with it. There are 4 concrete tools available to you right now. The first one is the most important for anyone whose income has already dropped. It's Form SSA 44, and I want you to write this down. If you've recently retired, lost a spouse, or experienced any significant drop in your income, you may be paying IRMAA based on a high-income year that no longer reflects your life today. The Social Security Administration has a form specifically for this situation. It's called the Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event Form, SSA 44. You can find it at ssa.gov, and you can also search Form SSA 44 directly. This form lets you tell Social Security, hey, my income is high in that year you're looking at, but here's what changed, and here's my income now. If you qualify, they can use your more recent lower income to recalculate your IRMAA for the current year. The qualifying life events include retirement or stopping work, significant reduction in work hours, marriage, divorce, death of a spouse, loss of pension income, and loss of income-producing property. If you retired in the last year or two, this form could save you thousands of dollars. Many financial advisors don't even mention it, but it exists, it works, and it's worth the 45 minutes it takes to fill out. Potential savings, depending on which tier you eliminate, could be up to $6,936 per person per year, according to CMS figures. That's real money. Pause. The second tool is something called a Qualified Charitable Distribution, or QCD. If you are age 70 and a half or older, and you have a traditional IRA, listen carefully. You can donate up to $111,000 per year directly from your IRA to a charity of your choice. That donation goes straight from your IRA to the charity. It never touches your hands. It never hits your tax return as income. This is completely different from writing a check to charity. When you write a check, the donation comes out of your pocket, and you may get an itemized deduction, but it does nothing to lower your Magi. Your IRMAA calculation doesn't change at all, but a QCD removes the income at the source. It never enters your Magi. And if that QCD also satisfies part or all of your required minimum distribution for the year, you've solved 2 problems at once. You've met your RMD requirement and you've lowered your Medicare relevant income. That's a powerful combination. A $20,000 QCD for a married couple right at the edge of the first IRMAA tier, say at $220,000 Magi, could drop them back below the $218,000 threshold, potentially saving $2,297 per year in surcharges. Every situation is different, so please talk to a tax professional about how this applies to yours. The third tool is what I'd call knowing your IRMAA. Before you make any large financial move, whether that's a Roth conversion, a home sale, a big IRA withdrawal, you need to know how much space you have before you hit the next IRMAA cliff. Here's a simple example. Suppose a married couple has $258,000 in Magi for the year. The next IRMAA cliff, Tier 2, starts at $274,000. That means they have $16,000 of room. If they do a $20,000 Roth conversion, they cross the cliff, and instead of paying $2,297 per year in IRMAA, they now pay $5,448. That's over $3,100 more per year for 2 years, triggered by a $4,000 mistake in the sizing of that conversion. The solution? Split it. Do $14,000 this year and $14,000 next year. Stay below the cliff both times. You accomplish almost the same financial goal without triggering the surcharge. This kind of planning is simple in concept, but it requires you to know the numbers before you act. That's the key. The fourth tool is about timing your Roth conversions correctly, specifically in relation to your Medicare start date. Because of the 2-year look back, here's what financial planners commonly point out. Income you earn at age 63 affects your Medicare premiums at 65. Income at 64 affects premiums at 66. So the income years that have zero IRMAA consequences are the years before age 63. For anyone not yet on Medicare, that's the window where Roth conversions can often be done more aggressively because they don't yet carry an IRMAA price tag. Once you're on Medicare, every Roth conversion has to be sized carefully. Not avoided necessarily, but measured, because the conversion income shows up on that year's tax return and will affect your Medicare costs 2 years later. I want to be clear. I'm not telling you whether to do a Roth conversion or not. That depends on your specific situation, your tax bracket, and factors only a qualified financial planner who knows your full picture can properly assess. What I'm telling you is that the timing matters, and most people don't factor in the IRMAA consequence when they're making that decision. Before I get to the biggest counterintuitive surprise in this video, I need to clear something up quickly, because I hear this misconception often. Some people believe that switching to a Medicare Advantage plan protects them from IRMAA. It does not. IRMAA applies to all Medicare beneficiaries who exceed the income thresholds. It doesn't matter whether you're in Original Medicare or Medicare Advantage. The Part B surcharge and Part D surcharge apply either way. Every Medicare Advantage enrollee still owes the standard Part B premium, and if their income is above the threshold, they owe the IRMAA surcharge on top of that. Choosing Advantage over Original Medicare is a separate decision with its own pros and cons, but avoiding IRMAA is not one of the advantages. Now, here's something I want you to sit with for a moment, because this is the part that most financial coverage completely misses. You can be paying IRMAA on income you no longer earn right now, today. Think about this. Someone retires in January of 2025. In 2024, their last working year, they earned $180,000. They were a high earner. They retire. Their income drops to $45,000 a year from Social Security and a small pension. In November of 2025, a letter arrives. Their Medicare premium is going up significantly. Why? Because Social Security is looking at that 2024 tax return, the year they worked, and calculating their 2026 Medicare bill based on that. They haven't earned that income in over a year, but they're paying Medicare surcharges on it anyway. This is not unfair in a legal sense. It's the rule. But it's a rule that nobody explains to you in the year you retire. and it leaves many recent retirees genuinely confused and upset about a Medicare bill that seems completely disconnected from their actual financial situation. The good news is that Form SSA 44 exists specifically for this scenario. Recent retirees are one of the primary groups this form was designed for. If this is your situation, that form may be the most valuable 45 minutes you spend this year. Here's another thing that almost nobody tells you. Writing a check to charity does absolutely nothing for your IRMAA. Nothing. Nothing. A lot of retirees give generously to their church, their alma mater, their local food bank. They write the check, they get the deduction on their itemized return, and they assume it's helping their tax picture. For regular income tax purposes, yes, it can help. But for IRMAA, the deduction doesn't reduce your magi. IRMAA is calculated before itemized deductions enter the picture. So your $15,000 in charitable donations that you've been giving for years is doing zero to lower your Medicare relevant income. That's why the QCD is so powerful by comparison. The QCD removes the income before it ever enters the magi calculation. Writing a check does not. These two approaches look similar on the surface, but the mechanics are completely different. Here's what I want you to take away from everything we've talked about today. The IRMAA bomb doesn't care what you spent the money on. It only cares what your tax return said 2 years ago. And by the time it goes off, it's already too late to stop it without a plan. Read that again in your mind. That's the whole thing. Let me give you 3 simple things you can do this week. Not someday, this week. First, if your income dropped because you retired, lost a spouse, sold a business, or stopped working, look up Form SSA 44 at ssa.gov right now, not next month, this week. That form may eliminate a surcharge you're currently paying on income you no longer earn. It could save you thousands of dollars this year alone. Second, before you make any large financial move in the next 12 months, whether it's a Roth conversion, a big IRA withdrawal, selling a property, or anything that could spike your income, ask yourself this one question. What will my magi look like 2 years from now? That single question is worth more than most financial advice you'll ever get for free. Third, if you are 70 and a half or older and you give to charity regularly, talk to your tax advisor or IRA custodian about qualified charitable distributions before your next donation. You may be leaving a significant Medicare cost reduction on the table every single year. And if you're married, talk with a financial planner about what your Medicare costs would look like for the surviving spouse. Not because you want to think about it, but because planning for it in advance is one of the most loving financial things you can do for the person you share your life with. Real quick, if you've made it this far and you're finding this useful, I want to ask you something. Hit that subscribe button and the little bell icon right now. Every week, we go through exactly this kind of thing. Real Medicare rules, real retirement traps, real tools. No fluff, no sales pitch, just the facts you should have been told years ago. Subscribe and make sure you don't miss the next one. Here's what I want you to leave with today. IRMAA is not random. It's not the government being arbitrary. It is a rule. A rule with cliffs and timing windows, and an appeal process that most people never use. The retirees who pay the most in IRMAA surcharges are often the ones who made good financial decisions and simply didn't know to plan around the 2-year look back. A home sale, a Roth conversion, an RMD that grew bigger than expected. Good things, or at least normal things, that quietly became expensive Medicare surprises. Now you know the rule, and knowing it changes everything. If your income has dropped, please look up Form SSA 44 at ssa.gov. That form could save you real money, and it takes less time than an oil change to fill out. If you're making any big financial moves in the next few years, pause and ask, what will my magi look like 2 years from now? That question is your shield. And if you want to keep learning about how Medicare, Social Security, and retirement income actually work together, you're in the right place. Drop in the comments and tell me where you are. Are you already on Medicare? Are you a few years away? Are you dealing with an IRMAA notice right now and trying to figure out what to do? I read the comments and I'll respond to as many as I can. Thank you for spending this time with me today. You deserve to understand the system you're paying into, and you deserve to know your options. Take care of yourself out there for educational purposes only, not financial, tax, or legal advice. Medicare rules, income thresholds, and IRMAA brackets change every year. Always consult a qualified tax professional, Medicare advisor, or a certified financial planner before making any decisions related to your income, retirement accounts, or Medicare coverage.